All right, in today's video, we are going to see how a business owner uses a whole life insurance policy. We'll see how he sets the policy up for the most cash value possible, then how he uses policy loans. So to begin, we've got a business owner. So here we go. He's got some money and wants to put it into a whole life insurance policy because that's going to grow for him and he can access it for his business. How he plans on accessing it is specifically through policy loans. So he's going to take money from his policy through a loan and then put it back into his business, which is his money machine. Now he does this with the loan feature because if he takes a loan, he keeps earning interest on his entire cash value. Any money still in cash value and what he's borrowed. We'll see an example of this. But when we look at his whole life insurance policy, here's really what he wants to see before he says, I'm going to put a lot of money into this product or any amount of money into this product. He wants to see, one, exactly what the cash value is growing by every year. Show me the positive, show me the negative, provide full transparency so I can see it, understand it, and then decide to move forward if it is a fit for me. Then he wants to see what's the loan interest cost. If I'm going to do this, if I'm going to borrow money against this life insurance policy, I feel like I'm borrowing my own money. A million people tell me that's not the way it works, but that's how I feel. So just show me what the loan interest cost is, and what I can do is compare that with the cash value growth. How I like to look at it personally is the cash value growth shows what I get from the insurance company, and then the loan interest cost shows what I give to the insurance company. And simply put, I just want to make sure that I'm not giving them more than what I'm getting from them in terms of the cash value growth and the interest cost. And then when I look at those two, I'll show you how you can make a decision based on the numbers. It'll be very, very clear when we put everything together. So what we'll look at here is a life insurance illustration. We've got it for a business owner. The cost to borrow, by the way, with this particular illustration is just under 5.25%. Here's the illustration summary. We've got $100K per year going in for 5 years and then nothing thereafter. Here's his cash value. Continues to grow over time. This is based on the current dividend rate. So these are the non-guaranteed values, but this is with one of the major mutual companies. We do track the actual performance of whole life insurance policies. And what I've seen to be the case is when a policy is set up for maximum cash value with one of the major mutual companies, we've seen them deliver on par with the illustrated values. They do adjust as the dividend adjusts over time, but we've seen them deliver attractive cash values. Policyholders have been very happy, which really gives me a lot of satisfaction and peace of mind too. Then we've got the net death benefit on the far right. And we can look at a breakdown of this illustration. Like if we wanted to go through it line by line, I would go down to the supplemental values section, as that gives us a breakdown of where our money is going and such. For the sake of this video, we're just going to look at it on Excel, and then we'll look at the loan scenario or the loan model. So what we've got going on here is the same illustration we just saw. First, we've got our minimum premium. So the premium piece is at $10,000. When we set up a policy, so this guy is paying in $100,000 per year. What we don't do is just get a life insurance policy where we have a $100,000 premium, or the insurance company and or agent says, here's your premium every year. I would not do that if cash value is your goal. What I would do is set it up in a manner where my cash value is maximized. So what a lot of people are not aware of is we can actually choose where our money goes. The premium, which I'll call the initial insurance expense, or the PUA rider, which I like to call a cash dump-in. PUA, by the way, stands for paid up additions rider. But here's what you'll see. If you're interested in the cash value, money you pay into the premium with most whole life insurance policies gives you $0 in the first year. Then as you continue to make premium payments, eventually you see those premium dollars come back to work for you. But I have a very zero or very low percentage of my premium that shows up in cash value in the first year. And the reason why is because the insurance company is going to overcharge me for the death benefit up front. Whereas PUA dollars show up in cash value immediately. That I can access. It begins to earn a return quickly. Like, that's the key to maximizing the cash value. It does get me some life insurance, but it's a very small amount compared to premium dollars. So since premium dollars don't give me cash value immediately and cause a lot of pain financially, I want to minimize the premium as much as I can. So we did exactly that in this example, and we have 0 of the premium in the first year cash value. The lowest we can push that premium with the top 4 major mutual companies is about 10% of our total deposit. So here you've got a $10,000 premium because that's as low as we could put it based on the total amount of $100K he wanted to pay in. So of that 100, 10% toward the premium, 90% toward the PUA rider, which is also optional. He doesn't have to add that extra 90K. In this example, we're assuming he does. Here's the total funding. First year, you paid in 100, you have $89,000 in change. That's the worst part about a life insurance policy. We take a negative hit right out of the gate. You're almost negative 11%. As the years pass, though, he keeps paying 100K per year. Year 4, what's highlighted in yellow, represents his break-even point. At this point in time, the cash value is equal to the total dollar amount he's paid into the policy when we look at this. Okay, so I no longer have a loss here. And after the 5th year, I pay 0 in forever, and my cash value continues to appreciate over time. You'll notice here, in the 8th year, we dropped the death benefit. Why we did that, look at the cash value growth. Years 6 and 7, you pay nothing. It grows by $23,000, then $24,000. Then in year 8, it jumps to 27, almost 28 grand in growth. The reason why is because we're not paying anything in. We reduce the death benefit to reduce cost and let the cash value grow at the fastest pace possible. That's exactly what's going on there. So that's his growth illustration. Now let's look at the loan. And here's what we've got. On the left, we've got the same growth illustration we just looked at. To the right, same policy, but in year 6, we take out a policy loan. If I'm you, I'm interested in how that loan impacts my policy. So I take that $300,000 loan. My cash value is the equity. This represents the money that you can access. So when you pull 300 grand and compare it with the example where you never touched it, you'll see the cash value drop. You'll also notice the death benefit drops by exactly $300,000. Before loan, it was 1.9898. After loan, it's 1.68. The 1.98 minus 300,000 gives you that dollar amount. That is collateralized when you take out a policy loan. Then he begins to repay it. This is optional, but he's paying it back at $50K per year. Light blue, that's his out of pocket. And of that $50K, you see how much is applied to loan interest in red and how much is applied to purple. That's his principal, loan principal that is. And when the loan's paid back, let's just go down to the bottom here. You've got $840,000 in cash value. And if we compare that with this over to the left, what do you notice? Everything's exactly what it was, as if we never touched it in the first place. There's no lost opportunity cost. So that is a big point of attraction. The last thing I'll hit on here is this. A lot of business owners want to see the difference side by side. Remember that last point we hit on there, how to make a decision? This is how individuals typically make a decision with the numbers. Show me what the cash value grew by and what I paid in interest every year. So this is exactly what we do when we take out a loan. We look at what we're paying in loan interest and what the cash value grew by each year, which was that column to the left, and we compare them year over year. This is what I like to do with individuals we work with before they take loans, after they take loans, when they have loans outstanding. It allows me to see everything and make a decision with confidence, or they just call us and say, can I take a loan? And I'm not going to be in the red. And I'll say yes, or I'll say no. But if you really want to use the money for your business, you still can. I would just try to pay this loan down by X amount of dollars over the next 12 months to get yourself in a position where I would scream, I'm paying too much loan interest. But the key here is when I pay a loan back, I see my value is fully restored. I continue to earn interest on my full cash value. Even though I had a loan outstanding, I can pay it back however and whenever I want. And if I really want to see the numbers behind it, to see if it makes sense, I would look at what my cash value is growing and compare that with what I am paying in loan interest. I hope you enjoyed this video. Please let us know your thoughts and if you have any questions at all. And as always, I hope this helps. Thanks so much.